Hi everyone, it's Chat about another video. Today I'm going to be doing another bi-monthly update of my UK dividend growth portfolio. Not all dividend stocks, however the main aim of this portfolio is to provide dividend income and gain dividend growth through mainly UK companies. 25% of this portfolio is a Vanguard S&P 500 fund, low fee. I think this should be the foundation of any portfolio really, wanting to find some diversification outside of the UK. Doesn't pay a particularly impressive dividend, and month over month there's been no real change here. I haven't particularly added to it. There's been some strength in the S&P 500, which has caused the position to appreciate a bit. But in terms of overall portfolio, I've been adding to some other positions, just not really changed that much. The second one on this page is DIAGEO, which has been down a bit in May. It reaches highs in around the end of April, start of May, which was around £38. It's come down a bit since then because of general weakness in the FTSE 100, which I'm going to talk about in a minute. I'm not too bothered by this. I'm very happy with this being the large position of individual stocks, and I don't really want to add to it a PE ratio around 23. When I bought the majority of this, it was more like in the 12 to 15 range during March 2020 downturn, so I'm quite happy with where this position is now. Not really interested in adding to it unless there's some weakness in the stock or that multiple just gets reduced significantly. The reason for the FTSE 100 depreciating so much this month, with it being back to its March level, so March 2023, which is not the end of the world by any means, but definitely some weakness in the FTSE 100, some poor sentiment. That is mainly because inflation is just not coming down fast enough, causing significant interest rate rises. Inflation went from around 10.5% to 8.7%, which is the Bank of England's predicted current rate, versus a target of 2%. That means interest rates going up and likely to continue to increase. They're currently at 4.5%, an absolutely frightening rise. You look from May last year, where the rise had already started. It was around 0.75% in May last year. It's now 4.5%, maybe looking at over 5, even 6, if inflation does not continue to drop much faster. Food prices are rising significantly in the UK, so I can see this continuing, and that has caused severe weakness in the FTSE 100 recently. And I'm not really sure it's been enough. Like, stocks have not dropped enough to versus the sentiment. I think it's a relative surprise that interest rates are continuing to rise as fast as they are. One such position that's suffering from interest rate rises is Redrow. Of course, any house builder is going to be suffering in a higher interest rate environment. It's around 13% of my portfolio. The stock depreciated a bit and I added a bit, so it's pretty much where it was last month. Stock is struggling. It's been down from what was almost a yearly high in May, where it breached £5 again. It's now below £5. PE is trailing, of course, at 5.2. That's pretty meaningless going forward, as house builders' profits are going to take a significant hit. However, Redrow's range is typically, it's not on the bottom end. It's more a mid-range type of house. They're typically above £400,000 at the low end. So it aimed at a different market, and it's typically more insulated from interest rate rises than other house builders, but it's still feeling the pinch. Dividends have been maintained for now. Not sure what's going to happen with that, but it's paying a healthy 4.4%. It's done decent year to date, with a 5-year return. Not really what I want. I bought quite a lot in the bottom in March 2020, and I bought on the way up. I'm a big fan of this business. I continue to be a big fan of this business, and I think when times are rosy for house builders, we could see a £10 price for this business, so a nice double out in my opinion, not to mention decent dividend growth. Next, at 10.9%, the third largest individual position in this portfolio is TESCO. Now this has rose 15.7% year to date. I haven't really added any more, even though I would be quite happy to. There's been other positions that I wanted to buy more. Redrow, for example, TRITAX big box, but it's trading at just 12 times trailing earnings. It's 4% dividend yield, or 15% year to date. It's kind of been business as usual for this. High food prices don't really affect them because it just gets passed down to the customer, and what it has affected earnings slightly, not really enough. Steady results, business as usual, carrying on maintaining its dominant position in the UK market with more than 30% market share. Strong dividends, great returns so far this year. It's an inherently safe industry in groceries, and it's the clear market leader. I really like this business, and I probably will add to it at some point this month or next month. Next is TRITAX Big Box REIT, just under 10% of the portfolio. This is another one I've been adding to recently just because its discount versus net asset value is crazy in my opinion, almost 25%. I made a video about this recently if you want to watch that. It's kind of like the UK realty income in terms of the composition of its portfolio, its quality. It has some Amazon in the portfolio, has a wide range of retail stores, relatively high quality, very high occupancy rate, conservatively run, exceptional valuation versus net asset value in my opinion, pays a 5% dividend yield, and over the long term, until really real estate started crashing because of the interest rate rises, this was a fantastic return over the previous 5 years. I think there's a lot of room for growth here, and when interest rates become more manageable, I think it will return to trading for a relative premium versus net asset value. This is the first, in the last year or so, this is the first time really it's traded at a significant discount to its net asset value. You could have picked it up for about £1.25 in August. That would have been more than 50% discount versus net asset value. It's absolutely crazy in my opinion for a relatively quality REIT with a decent dividend yield. Next up is GSK. Now don't be fooled by that graph because the Haleon split, it's spun off Haleon, so that has caused significant decline in the stock price at a certain point, but you gained Haleon shares if you're a shareholder. This is around 8.5% of the portfolio, had excellent most recent results with around 20% revenue growth and 20% EPS growth. I'm very optimistic about the future of this business, as 69 pipeline vaccines and medicines, the largest business segment, specialty medicines, in the most recent quarter was up 29%. It's currently trading at 10 times earnings, around 15 times free cash flow, with a 4.42% dividend yield. I really like this. The 5-year returns have been weak, but I'm hoping the spin-off of Haleon will create more focus. I really like the CEO, Emma Walmsley. I think there's a lot of potential for this business. A massive overhang on this business is the Zantac lawsuit, and one was just threw out in Canada, which is really important for this business. They will probably end up paying significant settlements. In the short term, that could hurt earnings and hurt stock price, but in the long term, I think this is a fantastic business with long-term potential and a much cheaper price than AstraZeneca, whereas AstraZeneca is perhaps higher quality but trades at ridiculous valuations in my opinion. I think GSK is the pharma company to own in the UK stock market. Next on the list is Boohoo, which is a stock that's often talked about in the UK stock scene and will raise some eyebrows because it doesn't have a dividend yield. I just wanted to add some growth to its portfolio. It doesn't solely have to be about dividends. I wanted to add some price appreciation, and I thought Boohoo was trading it's hard to say reasonable valuations, but I feel like I had a lot of optimism around Boohoo in the 40 to 50 to even 60p range of its ability to come back to over £1. Now, the thesis isn't broken by any means, but its results have been poor recently. There's no denying that. Poor earnings, $91 million loss, which swung to a loss, but the stock price was up 15% on that news, as you can see in that May, a bit on the far right of the stock chart. It has pretty miserable run. It drops in sympathy with ASOS a lot, and ASOS results were very poor, so it dropped around 10% just because ASOS results were bad. Again, I don't think the thesis is broken by any means. I think there's been some tough sledding for this business, but I think in the long term, I believe in the brand equity. I believe in its strategy of buying kind of distressed brands and bringing them into a larger marketplace and gaining value from that. They produce a lot of revenue, and I believe that with some efficiencies, they can get their margins back and become a decent business. I'm not expecting it to get back to £3 anytime soon, but getting back to £1 is much more realistic in my opinion. We just need some sentiment changes basically, and them to swing back to earnings. Next up is Admiral, which has pleasantly surprised me recently. I nibbled some more in that February low where poor US results really hurt the business profit, whereas the revenue was up mid-single digits, but the profits really weighed on it. It's had a big recovery since then, and that was really pleasantly surprising me. That's not what I was expecting from this business, and I would have been quite happy to keep chipping away at it when the PE ratio wasn't around 18 where it is now. I probably will add to this business in the near future when the PE comes more under 15. And it's the highest quality insurance business on the FTSE 100. Well, on the FTSE in general, I think its international segments are not performing terribly well, but that's often because in the US there's a lot more natural disasters than around the UK, etc. But it's an excellent conservatively run insurance business that pays a really strong dividend. While it says 3.53% there, I bought in around 4.5%, so I'm very happy with that. decent 5-year returns for the FTSE 100, really, because we're not seeing that, and that's without dividends included. Trading at perhaps not a reasonable valuation right now, but not far away, and I believe it'll drop down with the general weakness of the FTSE, and it has a ton of room to grow, in my opinion, eating up some competition from some relatively weak competitors. I think there will be consolidation in this industry from some of the bigger players. And the final position that's large enough that I think it's worth talking about is Unilever, which is just under 3%. I've not really added to it because I love it under £40. I don't love it at £42. I think that's maybe a bit on the pricey side. I think 18, 19 times earnings for a business that doesn't grow an awful lot, and while it pays a nice dividend and it has a lot of potential to grow, it really just isn't right now. And that I don't particularly believe in the management, but I think the management is coming under heavy pressure from activist investors. So in the near future, I believe that there's going to be some turnover in manager, and they're going to move towards not more aggressive growth, but less passive, in my opinion. They're going to remove the focus on ESG, which I think, while valid, is not really what this business should be focused on. It should be focusing on increasing revenue, increasing profits, and generally the increased revenue without increasing the profits has been the case recently. Although it has performed admirably over the last year or so, the lows of around £35 where I was buying slightly, it's bounced really nicely from there. Some of the other positions that are worth mentioning, Haleon, which I got in the GSK spin-off, not so interested in that. As I'm adding to other positions, it's kind of just sitting there. It's had some nice appreciation, but I'm not really adding to it. I'm probably going to sell it soon because I don't know enough about the business. I don't really want to know. Unilever is my consumer products allocation in this portfolio. I don't really need another relatively slow growth consumer products business. Legal and general position, which is paying an absolutely fantastic dividend, is growing, and I am increasing that, but not at an incredible rate. It's still a relatively small position because I've just wanted to add to better opportunities, in my opinion. But I do really like legal and general at these prices. And in terms of watch list, looking really closely at the banks, particularly Barclays for some exposure. They all look very cheap to me. HSBC, Barclays, Lloyds are the ones I'm looking at. Less inclined to look at NatWest, but that's just my opinion. Again, all of these are just my opinions. These are my personal positions. Make of that what you will. I'm not a financial advisor. You should do your own research and due diligence, not just buy, sell, or hold because I say so. And of course, whenever time you do buy stocks, capital is at risk. Let me know what you think of the portfolio in the comments down below. Let me know what your portfolio is. Let me know what you think of these individual businesses. Let me know what you think will be a worthwhile addition to this. You're probably going to tell me about Boohoo. That's absolutely fine too. Like and subscribe and enjoy the video. I'll see you again next time.